Sign 1. The behavior of big investors. Want to stay ahead of the market like the giants on Wall Street? Here's how these big players are leaving clues that you can follow too. Big investors, like hedge funds, banks, and asset managers, have more resources and access to exclusive information than retail investors. But here's the trick. When these giants start making significant moves, they can't stay hidden. In fact, their decisions leave a trail in the market that you can use to protect your money. Picture this. If BlackRock, Vanguard, or the world's largest pension funds start selling off stocks in certain sectors, it generates massive money movements that retail investors rarely notice. It's like a silent alarm. When they pull out, it's a sign there's trouble on the horizon, as they're usually acting based on deep analysis of global risks. For example, in 2008, large funds began reducing their positions in risky assets months before the massive crash. These moves were a warning of something serious approaching, but only those who were paying attention could see it and protect themselves. You don't need to be an expert to see these signs. Today, there are tools and websites where you can see what these big players are buying and selling. Even the 13F report, mandatory in the US, allows the public to see the holdings of major institutions each quarter. If you notice several large funds reducing positions in the same sector or selling in bulk, it's an alert. This could mean they're anticipating economic problems, regulatory changes, or a drop in demand in those sectors. Suppose you're seeing strong movements in the tech sector. Suddenly, major funds that have been accumulating shares in tech companies for years start selling. This change doesn't happen without reason. It could be a sign that confidence is dropping, and if big investors see it coming, you should too. Following the trail of big investors isn't a foolproof method, but if you know how to interpret their moves, you can gain a huge advantage. Because at the end of the day, it's always better to be safe than sorry. And now, you know how to get ahead of the market by following the signals of the giants. Sign 2. Increase in volatility. If you feel like the market is more nervous than usual, it's not just a feeling. This nervousness has a name and a measure: volatility. And when it spikes, it's a clear warning sign. Volatility measures how unpredictable the market is becoming. When big ups and downs become frequent, it means investors are unsure about the future. It's like the market is on a roller coaster with no clear direction, and this lack of direction can be a prelude to a downturn. A key index for measuring this volatility is the famous VIX, also known as the fear index. This index, usually calm and stable markets, spikes when the market goes into panic mode because investors start covering or selling their positions in response to uncertainty. Normally, the VIX stays low when the market is stable, between 10 and 20 points. But if you suddenly see it at higher levels, like 30 or more, it can be a sign that confidence in the market is crumbling. It's important to understand that when the VIX spikes too much, it doesn't always mean a drop is imminent, but it does mean the market is in a phase of extreme uncertainty. It's a time to be cautious and evaluate your exposure to risky assets. Think about 2020, when the pandemic began. The VIX shot up to historic levels because no one knew how long the economic impact would last. Investors who understood this and protected themselves in time avoided big losses and were then able to seize opportunities when the market began to recover. Volatility and the VIX can be your allies if you know how to interpret them. You don't have to be an expert to understand that when the market turns chaotic, it's time to put your defenses in place and watch price behavior with great caution. Sign 3. Bond yields and inverted yield curve. Did you know a simple curve can predict recessions better than many analysts? It's called the yield curve, and when it inverts, it's one of the clearest signs that something serious might be coming. The yield curve compares the interest or yields on short and long-term bonds. Under normal conditions, long-term bonds offer higher returns than short-term ones because investors demand higher compensation for taking on more risk over time. But when this curve inverts, meaning short-term bonds offer higher yields than long-term bonds, it's a clear sign of economic problems. Why? Because it means investors believe there will be instability or recession in the short term and are demanding higher returns to take on that immediate risk. Specifically, When the yield on 2-year bonds exceeds that of 10-year bonds, we talk about an inverted curve, and this has historically been a recession indicator within the following 6 to 24 months. It's an early warning that something might not be working well in the economy. You can check the yield curve on various financial platforms that publish this data in real time. If you see this curve inversion holding for weeks or months, take it as a strong warning. For example, in 2019, the yield curve inverted, something that hadn't happened since before the 2008 Great Recession. Investors who understood this signal were able to prepare before the market plunged due to the global uncertainty of 2020. The yield curve is an incredibly powerful and simple tool that even the most experienced investors use to anticipate a recession. You don't need to be an expert to understand that an inverted curve is a big stop sign. Sign 4. Declining corporate profits. If companies start making less money, be careful. It could be the precursor to a recession. When corporate profits begin to fall across the board, it's a sign the economy is slowing. If once profitable companies now earn less, it means consumption, investment, and demand in general are decreasing. This doesn't happen overnight, but accumulates in companies' earnings reports. When key sectors like tech, consumer goods, and energy report drops in revenue and profits, it's often a clear sign the economy is under pressure. Reviewing quarterly earnings reports from large, diverse companies is a good way to gauge the economy's health. If you see many companies across different sectors reporting declining profits, it could signal a broader problem. Major indices like the S&P 500 or NASDAQ usually reflect these declines. If analysts start lowering their profit expectations for the upcoming quarters, this could indicate they anticipate economic challenges. Think about what happened in 2008. Financial companies began reporting major drops in profits due to the subprime mortgage crisis. This didn't just affect the financial sector. It then spread to other sectors, eventually triggering a global crisis. Investors who saw these reports as a signal were able to adjust their portfolios in time. Corporate profits are the engine of the economy. If that engine starts failing, it's a clear sign to be cautious. Watching these reports and staying ahead can help protect your money before the market reflects the economic reality. Sign 5. Changes in central bank policies. When central banks change course, the market trembles. If they're abruptly raising or lowering rates, get ready for what's coming. Central banks, like the U.S. Federal Reserve or the European Central Bank, control interest rates and monetary policy, and these decisions directly impact the market. When they raise rates, they make credit more expensive, which slows down investment and consumption. When they lower rates, they try to stimulate the economy because they see signs of weakness. Abrupt changes in central bank policies are often a response to serious economic issues. If you see the Fed aggressively raising rates, it's because they're trying to control runaway inflation. Or, if they're lowering them suddenly, it's likely they're trying to prevent a recession. Pay attention to central bank meetings and statements. These institutions regularly issue statements explaining the reasons behind their decisions. A change in tone or policy direction can give you a clear clue of what's happening. Additionally, watching how markets react after these announcements gives you an idea of the confidence, or lack thereof, in the economy. If the reaction is nervous or a massive sell-off, it could be a warning sign. In 2022, central banks began raising rates aggressively to control inflation, which directly impacted asset prices. Those who understood this policy change were able to adjust their investments before prices fell. Central bank policies are like the thermostat of the economy. If rates rise or fall sharply, it's because they're trying to correct something serious. Staying informed of their decisions will help protect your capital and anticipate abrupt market movements. And there you have it. 5 key signs to help protect your capital before the market falls. Now that you know these indicators, you're one step ahead in making smart, safe decisions. If this video has been helpful, give it a like, subscribe for more content like this, and ring the bell. Don't forget to share it with someone who also wants to protect their money. See you in the next video, and remember, your financial future is in your hands.